BlueRock's a multidisciplinary entrepreneurial advisory firm, and we specialise in accounting, grants and incentives, legal, self-managed super, private wealth, philanthropy, finance, bookkeeping, digital and insurance. We also have an investment arm to our business, investing in businesses in the technology and hospitality-based areas. We're in a pretty fortunate position that not only are we running our own businesses, but we get to advise clients in that space. And from running our own businesses, we understand exactly what it's like. So the usual challenges such as cash flow, staffing, and all of that. So we're really fortunate that we have the opportunity to present from both perspectives. I've got a couple of great guests for you today. So we've got Jared Broadbent, who's a managing director in BlueRock Investments. Jared's got more than 27 years in investments and financial affairs for his clients. In 2009, he set up his boutique stockbroking firm and investment advisory firm, Broadbent Investments. And today he's going to be touching on a market overview and investing in defensive stocks. We've then got Claudia Basquet, who's a director in BlueRock Law with more than 20 years experience in personal and corporate insolvency and investment and commercial litigation. So she takes a practical and commercial approach to solving problems that suits our clients' needs. Claudia is going to be touching on insolvency and what to do when you think your business could be in trouble. I'll now hand over to Jared, who I'm sure has got plenty of gems for us today.
Thanks, Jo, and thanks everyone for taking the time to join us this afternoon. First thing I thought I'd touch on is a quick 60 seconds on what we do at BlueRock Investments. I mean, the ultimate aim for our clients is to make them as much money as possible without making too much risk. So we first sit down and find out everything we can about your financials and personal situation, then in conjunction with yourself, construct investment portfolios that suit your needs. And that'll be across Australian listed shares, international shares, property, infrastructure, fixed interest, and some unlisted investments, some venture capital, some property investments as well. It's a full portfolio and administration service, and clients get daily emails, and we touch base and review portfolios depending on the size and the requirements of yourselves every 1, 2 or 3 weeks. So it's certainly a fairly high touch business. Investment lessons. We wanted to touch base at the moment. It's a pretty unique situation. We haven't seen it for many years, where interest rates and inflation are starting to go back up again. So that creates some problems and some opportunities, and certainly some volatility in investment markets. So just a couple of lessons from many years of experience across the whole team. I think the first one is don't panic. The way you blow up investment returns is to sell at the bottom of a market, be it when the market falls because of COVID, or we had a pretty decent fall just a couple of months ago in May and June. So yeah, just simply don't panic, block out the noise, generally invest for the longer term in quality investments that pay you a good income. Might just pop down one slide there, Gemma, if that's okay, while we're chatting to this. And the final point I wanted to touch base on is, where are we now? As I mentioned a minute ago, in fairly unprecedented times with inflation rocketing and interest rates starting to go up. So as you can see by that chart there, May and June in the markets was pretty weak. That was on the back of the higher inflation numbers, fears of higher interest rates. It has just rallied up a little bit at the start of this financial year. We've had a pretty good month and a half. And that's interest rate expectations just came back a little bit. There was some value in the market. The profit reporting season that we've just had was also pretty solid as well. What we did do for clients in the model was, back in June, we just added to 3 or 4 different exposures back then. And just in the last week or so, we've just been taking, after a pretty good run in the markets, we've just been taking a little bit of money off the table and cashing clients up just a little bit again. If you've got fresh cash to put into markets, we would just advocate just holding off for a few weeks, a month, to see what the market does. We just might get a little period of weakness here. Normally markets do pretty well through the Christmas period, November, December, January. So you might just get a decent buying period through September or October, and we should enjoy hopefully a reasonable improvement into the end of the year. Just moving on to the next slide, a bit at a sector level, and also what are the sort of investments that we're focusing on in volatile times. Look, almost any time, but in volatile times, it pays. Prefer large cap exposures. We want stocks with strong cash flows, low debt, generally high yields. I'll focus on that a little bit with defensive valuations. I think the other key point I haven't made here is invest in companies that have pricing power. If a company's costs are going up and they can't put up their prices at the same time, they're going to be in trouble. So focus on quality. And just at a sector level, financials, property, mining had all pulled back a little bit during the June market retreat. Healthcare held up pretty well. So the market went into the defensives like your CSLs and ResMeds to an extent. Just touching on a few of the different sectors and how this current volatile environment of higher interest rates impacts those. Infrastructure, firstly, is a great asset class. We like it. We had a lot of money in Sydney airports. We've got money in Atlas Arteria, which is overseas toll roads and Transurban. Normally, higher interest rates hurt infrastructure investments a little bit, although with the case of the toll roads, they're all linked to inflation or CPI. So we've got rising inflation at the moment, so toll prices are going up. They've got pricing power, so very happy to own infrastructure where it's linked to inflation. Transurban's pulled back a little bit. Traffic numbers are recovering post-COVID. If they pull back a little bit, certainly one we're happy to buy again. I might just skip property for the minute because I'm going to focus on that on the next slide, but resources, normally quite a volatile sector, normally keep away from it a little bit during periods of volatility, but the majors, BHP, Rio, Fortescue, Woodside, making huge profits at the moment, paying out huge dividends. We love things that generate a cash flow because if the market pulls back or the market's going sideways, but you're getting really good dividends off your investments, that's fine. So that yield's giving them a certain amount of protection. Finally, financials. Higher interest rates actually help the banks to an extent. What they can earn, the margin between deposits and loans has widened out a little bit again once the interest rates have picked up. So slightly higher interest rates have helped the banks. If they get too high, of course, you'll end up getting some bad debts and the like, which will cause them problems. But for the moment, with full employment, bad debts aren't a problem for the banks at the moment. So higher interest rates have actually helped. I've got the ANZ slide here. It's been the worst of the major four banks, but certainly the cheapest. A grossed up yield, including franking, of over 9%. One we're happy with. Macquarie Bank is the best of the banks / financials. So anytime you can buy them on weakness, happy to do so. And they're pulling back a little bit at the moment. Haven't mentioned insurance on this slide, but insurance is another sector that is aided by higher interest rates. And that's because they earn money. You pay an insurance premium. They sit on that cash for a period of time and they earn money on that deposit. So insurance is another one, QB and Suncorp, that are pretty well placed. Just on to the next slide, property. I'm sure it's one that's of interest to a lot of people. And there's so many, we don't have the time here to cover off on all the different property classes, residential, commercial, office, shopping centres. But just to say that the listed property trust space has come back a fair bit. That chart, SLF, is a proxy for the listed property trust market. It actually fell almost 30% from highs to lows over 6 months, and it's recovered a bit. But there's certainly some value in this space. So whilst higher interest rates hurt it, I think that a 30% fall in the sector's more than covered off on some of the risks. C&I is just one that we own in the model portfolio. It's trading below asset backing. It's actually down now. Last week or two, it's faded a little bit. So it's down in the 180s, trading below its asset backing, and it makes money on a $20 billion property portfolio that it manages. So one to think about. On to the next slide, fixed interest and credit. This is one area, it's almost been uninvestable for the last 3 to 5 years. You're not getting any returns on your cash, on your term deposits. They're still pretty low. but a couple of them, you might have heard of these bank hybrids. From a credit quality point of view, they're marginally more risky than a term deposit, but they pay quarterly distributions. We stick to the major 4 banks, often franked, and they're now yielding 5.25% to 5.5%. Very stable, solid, and by Christmas time, we'll get another couple of rate rises. They'll be in the 6s. So if you've got cash there and don't want to take much risk, but happy to take a bit more risk than leaving the money in the bank, hybrids are a great option for you. At the bottom on this chart is something called a KKR credit fund. There's some credit funds that are trading on the market that are trading below asset backing, paying monthly dividends and yielding quite a bit. So a KKR credit fund on a 7% yield is another example of an option that you may have. The next slide is international listed investment companies. We generally underweight offshore investments. They're a little bit more volatile than Australian markets often. They don't yield as much, but of course they have had better growth over the last decade. But just flag this one as an opportunity. If I'm right and the markets peel back a little bit in the next month or two, you can buy, I use Magellan as an example because it's a little bit controversial, but it's been in the news lately, but it's trading. So this Magellan Global Fund owns a basket of international shares, all major companies you would have heard of, and they're trading 20% below their worth or their net asset backing or the total sum of their investments. So one to keep an eye on. Just on the next slide, just highlighting the model portfolio and just coming back to what I said at the start in volatile markets, just be a long-term investor, don't panic at the bottom. We started a model portfolio in Feb 2016, so it's gone 6.5 years with a $1 million balance. It's predominantly an Australian equity, property and infrastructure portfolio. It's up 7% since July 1 and around 117% since inception in 6.5 years. If you return 10% on your money per annum, your money doubles every 7.2 years. So just ride volatility out. If the market's high, take a bit of cash. If the market's low, put a bit of cash in. But yeah, just don't panic. We might just roll on to the next couple of slides slowly, and I'll just show you the model portfolio as it is at the moment. You may be of interest. It's up 7% for this financial year to date. On the next slide is an example of some of the shares that are in it. You'll know most of them. Centuria, Eleanor's, Garters. There's some smaller property trusts that you won't know so well, but you look at some of those yields. Garters a bit lower at 4, but Eleanor Retail 16, Eleanor 9, and that's we like the portfolio. This model portfolio generates a yield of about 6% per annum. So we're targeting double-digit returns to clients. If we're getting a decent start at a 6 in front of it with the yield, we don't have to make huge capital gains to generate great returns for people. On the next page, the only one you don't know is another example of a defensive quality investment is Redcape. It's unlisted. It owns pubs throughout Australia. It does have some game machines. There is a gaming element, but it's yielding 10% at our purchase price and yielding about 6% at current prices. That just about does it for me, but I guess the main themes are higher inflation and leading to higher interest rates. We haven't seen it for a while, but don't panic. If the market pulls back a bit, we're happy to stay invested, happy to look for opportunities. There are some sectors in the market that benefit from higher rates, and there's certainly some fixed interest opportunities there that are now worthwhile to invest in, which have not been particularly worthwhile over the last 3 to 5 years. So if you've got any interest in our morning email or the model portfolio, just give us a shout out and we'll be able to put you on the distribution list. Hope that helps, and I might hand it back to Joe. Thanks, Joe, for helping out.
Thanks, Jared. So today I'm going to be running through managing your cash flow in particular. So having a look at the micro detail of managing your revenue and expenses, so looking at your income statement, then your balance sheet, so having a look at your assets and liabilities, then going outer ring to have a look at your job costing, product or service costing, then your forecast and scenario analysis and some reporting. So we'll pop on over to the next slide and have a look at the revenue, which is obviously bringing all of that cash in. So client care is a really big one for us. It costs a business between 5 and 25 times more to acquire a new customer than to retain an existing one. So clients are looking to build genuine connections and have a unique and personalised experience. We're well aware in our industry of the introduction of all the technology that a lot of the traditional role, particularly of an accountant, won't exist moving forward. But we're pretty confident that our relationships will hold us in good stead along with the use of the technology. When looking at your client acquisition, you've got two types, which is your organic growth, so your word of mouth, expanded product offering, or your inorganic acquisitions, which is generally your mergers and acquisitions. And when doing those, it's really important to make sure that you've done your due diligence to make sure that the acquisition is going to be a great fit for your existing business. Moving on to having a look at expanding your revenue streams. So training up your team, maybe training clients in some of the services you can do, hiring out excess equipment, subletting excess space, having a look at if there's any other additional revenue streams on the table. So they might be having a chat with our grants and incentives team, whether you might be in the market for some of the research and development grants. So that's where your business is innovating and there's a risk that things could go pear-shaped. So the government will contribute partly to spend in that area. There's also current grants such as the Female Founders Grants or the Export Market Development Grant. So if you're looking to take your product or service overseas, if you're spending money there on advertising, a trade fair, seminar, all that sort of thing, pop us a line and have a chat with our team, Tom and Millie, as part of the R&D team, because often there's some grants and incentives that you're just not aware of. Having a look then at presenting your brand and aligning that with your ideal client. Now, ideal clients can actually change over time. Sometimes you might want volume, sometimes you want a more boutique, individualized sort of experience for the client. So really considering your values and being transparent with your business practice is super important. Clients are looking for brands that offer transparency, add value to their lives, and connect on more of an emotional level. They're also looking for compelling content that educates and informs, such as blog articles, direct emails, social media, hopefully things like today's webinar. They're also looking for brands that can align themselves with sustainability and an opportunity to contribute to society in a positive way. And that's one of the reasons we've set up our BlueRock Foundation, to make it easier for both clients and our staff to contribute to society in either a financial way or a time-based way. Having a chat with your digital strategist and having a look at your brand and content creation, websites and e-commerce, paid media advertising, and market optimization. And a big one in terms of trying to actually grow your business and bring on new clients is being really mindful of the messaging that you're using. So often we'll say to someone, oh, how are you going? Oh, I'm really busy, under the pump, drowning, this sort of thing. They're not the sort of person that I want to be referring work to. So being really clear that, look, our business, we're open for business. This is our team. This is what we're good at. This is how we think we can help, rather than sort of going with that default response of, oh, I'm really busy and drowning. The next area we're going to have a look at is the expenses. So again, working further through that profit and loss. And this is really about stopping the leakage and making strategic spend. So the most common and biggest expense for a lot of businesses at the moment is staff. And it's really important to consider other ways to attract and retain talent. It's not just straight up cash that everyone is after. So other ways that you can attract and retain or incentivize staff is the opportunity for them to buy in, maybe through an equity model, or to earn some shares or some equity through an employee share ownership plan. We run some feedback sessions with our staff, and the things that they were also looking for was training and development, career progression and pathways, recognition and appreciation, a focus on DEBI, so diversity, equity, belonging and inclusion, and the opportunity to give back. The next biggest one is generally materials for those businesses that require them. So if you're in property and construction, obviously using a fixed price contract at the moment makes life really difficult when prices have increased so much on supplies. So considering whether it's an option for you to use a cost plus method. And also in terms of the construction contracts, having a look at the time from when the contract's locked in to when you're likely to start, and making sure that you've factored in those price increases. Freight is another area that's caught a lot of people out lately, with it also increasing around 30 to 40%. So making sure that you go back and have a look at the historical data you've got to work out, well, roughly what is now the percentage of the freight compared to the actual goods that you're transporting, and making sure that you've put in enough margin for that. Another area to review is your ongoing contracts, and the biggest one for a lot of people is the rent. Whether there's an opportunity to negotiate a discount to pay up front or to pay early, making sure that you're reviewing the boring things like the electricity, the phone contracts and other leases. Had a client the other day that has a warehouse and had been renting their forklift for the past 5 years. That worked really well for them in that, if there was any issues with it, any maintenance, that got taken care of. But they were paying the same leasing fee now for the equipment that was 5 years old. So it probably wasn't worth that now. So worth going back to the people that they were leasing it from to say, look, this asset's not worth exactly what we were paying previously. Can we negotiate a discount or look at a newer product that maybe is more efficient for us? So we'll then move across to the next slide, which is having a look at your balance sheet and particularly your assets. So we want to make sure that our assets and liabilities are working for us. And again, there's no leakage. So having a look at what cash we've got available, if we're fortunate enough to have excess cash, can that actually be better distributed elsewhere? Can we invest it in another business? Is it worth having a chat with Jared and his team around some investments? There's also the asset protection issue. If we've got large amounts of cash or equipment sitting in an operating business, we'd consider this fairly at risk. And if something was to go pear-shaped with the business, we really don't want that to be up for grabs. If we're looking at insufficient cash, having a chat with the finance team to work out what other options might be available. And I'll touch on that further in the liabilities. In relation to debtors, it's really important to review them regularly. Don't let them get old. And what we do is actually set targets. So for us in the accounting division, we have got a target of 60% of whatever our opening debtors are for the month need to be collected within that month. And that information circulated. We have a target, a time frame, and can get some help with that. Making sure that you involve the team. So good service, quick responses, happy clients, they'll pay on time, make sure we're giving clear fee estimates and there's no surprises there. But it's definitely a team effort when we're looking at servicing our clients. If we've got equipment, have we got excess equipment that maybe we don't need anymore, we could consider hiring that out or selling it. Another option, if we're looking to free up some cash flow, is if we already own a piece of equipment, taking out some finance against that to free up the cash against that. So depending on the age of the equipment, the financier will lend actually up to 120% of the value of the equipment. And the rate is generally between about 6 and 8% on that. So that can actually be another sort of easy win if we're just looking to free up some cash flow for the business and we've got assets there that we can borrow against. Moving through to the liabilities and the funding, having a look at what sort of funding is appropriate for your business. Does it fluctuate sort of up and down? Are we in and out of positive or negative cash position? Maybe something like an overdraft is more appropriate. If we've got loans in there, making sure that we're reviewing those rates. And our BlueRock finance team are very happy to have a chat and have a look at that. One of the benefits of working with our guys is that they're used to working with people running privately owned businesses. So they understand that not everyone's going to have just a pay slip, that you might have a more complex structure. But being ex-NAB business bankers, they also understand what the bank needs to see. So we're able to work closely with them to get some really great solutions for our business clients. The ATO is another one. So really making sure that we manage any payment plans. If it's just a short-term issue that we've got with cash flow, maybe an ATO payment plan is a good option. It's really important, particularly at the moment, to be actively engaging with the ATO. They've issued more than 50,000 director penalty notices since 1 June this year. And that's for items such as PAYG withholding, GST and super guarantee that the directors are personally liable for. And Claudia is going to touch on more of that in her section, so I'll move along to the next slide. So the next one is making sure that we've got a plan, and that's our budget and forecast. I don't want to be running a business off, I think this, I think that. We want to know exactly where we're at. And a common misconception, often when I ask a client, have you put together your budget and forecast? They go, yeah, I have. They'll send it through and it'll just be the sales line. We actually want to go through much more depth than that to make sure that we're making money on each of our jobs right through to the bottom line. So when looking at our service lines, our product lines and our job costing, making sure that we're actually making money on each job and each product line, that we've costed it out, that we've added in freight, we've added in a percentage for overheads, and we've added in some profit for all the blood, sweat and tears that the owners go through in running their own business. Then we move on to the plan and the scenario analysis. So none of this budget and forecast is a set and forget. We'll set up the base budget to begin with, and that'll just be your best estimate at a point in time. And you'll get better each time that you go through the process. And then what we want to do is be able to run scenarios. So what happens if the interest rates continue to rise? What if there's a contractor that we want to make as an employee? When am I going to run out of money? How much can I pull out? When can I put on the extra person? If I've got lumpy payments such as in property and construction, if person X doesn't pay on this date, how short am I going to be? What am I going to be able to do to mitigate that? For the owners, also having a look at their game plan. So, when do they want to step back from working in the business? What level do we need to be generating profit in order to enable that to happen? If we're paying a large amount of rent, when can we actually afford to purchase maybe a commercial property in our self-managed super fund to operate with the business as a locked-in ongoing tenant? How much do I need to keep aside for tax, GST, working capital? If the end game is an exit, either partial or full, well, what's an investor going to be looking for, and making sure that we can plan around it in advance. So the same as if you're looking to buy a house in 12 months, have a chat with the brokers and that now, so that you can put your plan in place and be good to go at the time when you're ready. Then in terms of the reporting, so having a list of questions that you're going to need answered is going to be really helpful. And then thinking about the presentation of that information. So for us as a business, we use Spotlight reporting. We have a combination of tables, of graphs, of profit and loss. Personally, I go for the figures and I don't look at the graphs, but I know other people look at the graphs and don't look at the figures. And so you might have one business partner that's really detail oriented and one that's higher level, but having a reporting pack that services everyone is really important. And within that, there's going to be things that are going to be of interest to a client. And then there's going to be things that we need to be of interest to a client. We're going to have a look at your actual results versus your base budget. Then what we're doing with some of the newer modeling technology is actually able to bring through your actuals versus a live reforecast as well. So if we've set our base budget, for example, with sales growth of 5%, we're tracking along, having a look at that, and then we find that we've actually been doing 7%, so even better. The model will actually pull through and reforecast so that we're looking, well, if we continue on that trajectory, what do the results look like? And then that flows through to, well, what's our cash position? What can we draw out? When can we buy that new piece of equipment? And so on. We then want to be able to divide up the information. So to run a profit and loss by an employee or fee earner or sales rep, by a team, by a product, by an investment. And the really important one is knowing, as I said, that cash position. So knowing, are we in trouble? Are we going to be in trouble? If we know that we're going to be short on cash in 6 months, all right, we know that and we can put a plan around that, rather than getting to that 6-month period and going, oh, we're really short on cash. What are we going to do? Knowing in advance can be really helpful. So we've just run through reviewing your income and expenses, assets and liabilities, popping together your budget and forecast, and running through scenarios and reviewing your reporting. So that's all from me today. Please do feel free to pop any questions that you've got in the chat, in the Q&A function. We'll go through some questions at the end of this session, but we can also come back to if we don't get time. So next, I'm going to pass over to Claudia. So as I said, Claudia's got more than 20 years experience in personal and corporate insolvency and commercial litigation. She, like our lawyers here, take a really practical and commercial approach, which really suits our client needs. So I'll hand over to Claudia to talk to you about insolvency and what you should do when you think your business is in trouble. So thanks very much.
Thank you, Jo. Jo's information that she's provided actually flows really well through to some of the information I want to talk on today. Some of it is focused on before you're in financial difficulty and hopefully avoiding that, and then obviously some of the things that you can do if you are getting to that point. So the first point on financial difficulty is knowledge is power, and that's know how you're tracking, and Jo's provided some really fantastic information to ensure that you know is what is going on from that perspective. Part of that is also knowing when to seek advice and to seek it early. Legal advice in some respects is a little bit like taking out an insurance policy. You don't like paying the premiums and you wish you didn't need it, but it's there just in case something goes wrong and you know it's going to put you in a much better position having had it. So part of that is looking at asset protection, both early and ideally before there's financial difficulty, but there are some things available to you if you're aware that that is a possibility down the track. That involves also looking at your security position, and I'll go into that in detail in a moment, and also being aware that there is restructuring opportunities and knowing when to potentially put those into place. A lot of this does come from providing information to your advisors, whether it be your accountants or your solicitors, as to what's going on, and they'll be able to help issue spot for you to put you in the best position possible and provide you with the best outcome to keep your business going. So there are formal and informal options available depending on what the situation that you're dealing with is. Obviously, the more drastic ones are if a company goes into liquidation or an individual needs to go into bankruptcy, but there are lots of things that can be done before those final outcomes, which ultimately result in a business being lost and personal assets being lost. Some of those include safe harbour, which is a formal but prior to appointment of external administrators. So that involves working very closely with your accounting and your legal team to put in place a plan to determine whether or not your business is able to trade out of the situation that it's in, while protecting you from some of the nasties that are there if it turns out the company is trading insolvently, and provides personal protection to the directors while that's happening. There's also small business restructuring provisions, which have become a little bit more utilised. They're still very underutilised. They are very specific to the events available or the businesses available that can utilise them. But insolvency practitioners are seeing really good outcomes coming from using the small business restructuring provisions. So they're aimed at small to medium enterprises whose debt levels fall within the cap of under $1 million. You've got to have the employees need to be paid and up to date. So there are certainly some criteria which exclude people from being able to use them. But again, if you're seeking advice early and you know what's going on, then that can be a really good method available. And then there's the more formal option that most people would know about, and that is a company going into voluntary administration. again, with the right advisors and the right plan in place. The purpose of that would ideally to be have a deed of company arrangement proposed and accepted by the creditors, which will deal with cents in the dollar, either immediately through a lump sum or through trading funds coming into the company, to allow it to come out clean in the end with its debts it was unable to deal with covered off on. It might involve a change of directorship or shareholding as part of that, some other form of restructuring, but allows the business to deal with whatever problems had occurred and to then trade on from that point with no outstanding liabilities that it needs to deal with, and hopefully avoiding those problems into the future if you've had the right advice and systems and information that Joe was talking about put into place. As part of all of this, and we might move on to the next slide, putting yourselves into a position where you can hopefully ride the financially difficult times or protecting yourselves from them is really important. And a lot of these things I'm talking about have an application both to your business and your personal position and how you interact with your business, but also how you interact with your customers and your clients. There's very much two sides to the coin, and you need to make sure that you are focused on both of them to put yourselves in the best position. So ideally, you want to put yourself in a best secured position you can when you're dealing with debts and liabilities of yourself, your company, or your customers. So there's two main sorts. One is against real property, which is caveats and mortgages. Quite often you'll see, obviously the bank will take a mortgage. You might have suppliers seeking to be able to lodge a caveat against real property, or it might be something that you seek to do. But almost everything else is covered by the Personal Property Securities Act. Now, this Act's been around for 10, 12 years now, but it is still very underutilised by a lot of the business community, and it's something that it's really important for you to understand how it impacts you and how you can utilise it to your advantage. So the Personal Property Security Act deals with something called security interests, which is basically comes from any interaction where credit is involved. So the main one that most people would know about would be retention of title, where if you're supplying goods to somebody, those goods remain yours until they've paid for the items or hopefully all the debts in full. And that comes down to contract and how it's written. I'll talk about that more in a moment. If you're providing a director loan and providing funds into your business, that gives you an opportunity to take a security interest over the assets of the company, and is something that we would strongly encourage everybody to do, because it's going to put you in a better position if things are going wrong to perhaps be able to recover and start again, or control what happens with the rest of the creditors in how you're going to deal with an insolvency situation. And equipment leases is the other one that sometimes falls off the radar and people aren't aware of. It's especially important if you have intercompany dealings where you're using an asset holding entity and a trading entity, but also if you're in any way involved with leasing your equipment to others or even from others. So it never used to be the case that an equipment lease gave rise to potential loss of ownership of that asset, whereas under the Personal Property Security Act, it does. After an item has been on lease for 12 months, if there's not a registration on the PPSR, and I'll come to that in a moment as well, you run the risk of losing ownership of that piece of equipment if the person that's hiring it goes into liquidation. And that can have very significant impact on your business unnecessarily. So the way of ensuring that you're best protected in a security position is to have a registration on the PPSR, which is effectively a notice board set up by the PPSA where you pin to it a notice to the world: I've got an interest in this asset, I've got an interest in this piece of equipment, I've got an interest in this stock that I've supplied, I've got an interest in everything until this debt is paid, depending on how the terms are set up. If you haven't pinned on that notice board and the entity goes into liquidation, you will lose all rights to it. It's a very simple thing to do. It's not very costly, but it must be done beforehand. And there are some relatively strict timelines on when those registrations should happen. Again, better late than never, but you do have a risk for a certain period of time if you haven't done it in the legislated time period. So part of putting yourself in the best position possible is to ensure that you have good paperwork. So you want to be entering into written loan agreements. You want to ensure that you have good contracts and terms and conditions amongst those. And you need to be having conversations about what the law requires you in order to protect yourself, to ensure that you put yourself in the best position if your company's in trouble or if your clients or customers are in trouble. Which leads us into preference payments, which is something that will happen if a company has gone into liquidation. Just move on to the next slide. You'll be able to see that this is very much one where you've got some control over what's going to happen. The liquidator of a company is going to look to try and recover all the assets available to share out to the creditors. And one of the big ones that they're going to look at pretty quickly is what payments has this company made to its creditors in the last 6 months? Can I bring any of those payments back in order to share it out with the rest of the creditors? If you're a secured creditor, you're going to fall outside the purview of this, which means that you're at no risk of having to repay any monies that you've earned and potentially worked hard to have paid to you because this company was in some trouble already. So having in place those security interests through the PPSA, having your terms and conditions set up in such a way that you have the security interest and you cover as much of the assets as possible, whether it be your supply or all the assets of the company, will protect you. And you have to have that documented. You have to be able to prove that's the case. So that's part of having the records in place. The flip side of that is if you are chasing for this debt and the company has effectively admitted to you that it's in some sort of trouble, or there is enough information there to suspect that they're in trouble, if your security isn't worth enough or you haven't got it there, then you may end up having to pay some money back. So it's really important to be conscious of the method you're taking to recover your debts and weighing that against the recovery and the risk of paying it back, and deciding how you're going to structure that and how hard you're going to chase, whether you're putting them on stop supply, whether you're sending legal demands, and making sure that you've made a conscious decision on what your options are going to be and having a policy and sticking to it. The best policy, obviously, is to require them to stick to the trading terms, put them on stop supply if they're not. If you're lucky enough to be able to do so, have them paying up front. But there is always going to be a balance in any business world as to what's going to be commercial and what's going to work for your business and your customers. But it is something that you should have had a conscious decision about, and it fits in a lot with what Joe was talking about, of not just excuse me, playing things how they go, but actually making some decisions as to what you're going to do. The last thing that I just wanted to touch on was the director penalty notices, which the DPNs that Joe mentioned. And she is absolutely correct that the ATO is becoming more active in pursuing these outstanding liabilities. We had a long period during the last couple of years where the ATO were not actively pursuing debts, and they're very much now gunning for recovery of as many as they can. The really important thing to understand here is that, notwithstanding the fact the liability is that of the company, a director can become personally liable for unpaid PAYG, GST, and the superannuation guarantee charge. And this liability can arise for debts not just incurred during your tenure as director, whether you've resigned now or not, but you can also, if you're becoming a director of a company, be liable for those debts that were incurred prior to your involvement. Now, there are two types of DPNs. It's really important to understand how your business is operating and interacting with the ATO, because it's going to determine whether you end up with a 21-day DPN or a lockdown DPN. The main difference between them is the period in which you're actually reporting your liabilities. So PAYG and GST needs to be reported to the ATO within 3 months of the due date. And the SGC, the superannuation, needs to be reported by the due date. If those things happen and the debt isn't paid to the ATO, what I'm saying there is you need to make sure you lodge irrespective of whether you're going to be able to pay. Because if you can't pay and the ATO does issue a DPN, you have options. You have 21 days from the date the DPN is issued to be able to pay the debt in full. And if you can't pay the debt in full, appoint an external administrator to the company, which is something you should definitely be getting your advisors involved in, because there are some technical steps involved to ensure that that happens properly. Appointing a small business restructuring practitioner. Again, you may not have enough time to do that unless you'd already been looking at those options prior to a DPN, but have the conversation as soon as possible, or the company being wound up. If you don't do one of those things within 21 days, you will be personally liable for the full amount of the debt that the DPN relates to. The importance of ensuring that you've lodged all of the things in time prior to that is, if you haven't, if it wasn't lodged, the PAYG and GST wasn't lodged within 3 months and the SGC wasn't reported by the due date or remains unreported, the type of DPN you'll get will be a lockdown. And that will mean you'll be liable for the debt in full from the date of receipt, irrespective of what you do. And the only way you'll get out of it will be to pay the DPN. So that's probably, I think, all the information that I can provide at this point. By all means, if you've got any concerns about any of this information or you want some further details, feel free to contact myself or Joe or Jared, and we can talk you through the things that are relevant to you. But I'll hand over to Joe now. I think there's some questions that need to be answered. Thank you.
Awesome. Thanks so much for your time, Claudia and Jared. If any of the guests would like to pop some queries into the Q&A, I can run through them now as well. So first question I've got for Jared from the floor. So how do clients best engage with you, and what's the process you go through with them? What sort of balance does a client need in order to engage with you or for it to make sense?
Thanks, Joe. I just think if someone reaches out, send us an email or give us a call, that'd be the best way to start a dialogue. We would then preferably catch up with the individual face-to-face, or we can certainly do a Teams meeting or a phone call as well. But we just go through and tell you in more detail about what we do and how we do it, and find out as much about the client as possible, as much as they're happy to tell us. There's no charge for initial meetings. We would often normally then go ahead and do an investment proposal for you as well, so you get a bit of a feel for what something that we manage for you might look like. Again, there's no charge for that. If you come on board as a client, we charge a management fee of 0.6% per annum with a $3,000 minimum. So normally need in the range of 300,000 or so to make the numbers stack up and make it worthwhile.
Awesome. Thanks, Jared. So Claudia, one that's come through for you. So a really common scenario is where a family member of a business owner or a business owner lends some funds to the business. Can the family member use the PPSR to register a security interest by the company? And what is that over? Is it over an asset, or is it over the company in general? And what's the sort of cost or process involved in that one?
Look, absolutely. And we would highly recommend that people do that process. The PPSA is there to allow security to be taken over any asset, as long as there has been credit supplied for it. So if funds are being lent into a business by a family member or by a director, then ideally there should be a written agreement acknowledging that that's what's happened. That's your first piece of proof that you're going to need, that there was monies loaned. Setting out the terms of what the repayment are, or whether it's just going to be on demand, whether there's interest, and that the company is granting a security interest over a particular asset, an asset that the money is being used to purchase, which actually gives you an even higher level of recovery above a bank that has a general interest in everything or over everything. So there is no set criteria as to what that security can be taken over. It's whatever is going to work best for the company. But the important thing is to put it in writing and then to ensure that registration happens in order to ensure that the money that's coming in from your family and friends is what some of the first amounts that are paid back if something does go wrong.
Awesome. And in order to put that charge in place, is that something that clients could contact you for? Or is it something they would do themselves?
Look, it can be done by people individually. We would normally recommend having a conversation with somebody first as to what's involved, because very much so, if you miss one of the technical requirements, it's not going to be effective. The cost of actually doing the registrations, if it's something that you're going to do again in the future, is quite low. It's sort of $15, $20 charge by the government to do this registration. But the important aspect is making sure that you've got the paperwork right and the security interest set up properly. So look, happy to have initial conversations with people as to whether they need some help. And then obviously we can do that if they do.
Awesome. Another question that's come through for you, Claudia, is how do I know if I'm insolvent? Does having negative cash flow or making a loss in 1 year in a business automatically make me insolvent? Like, what are sort of the indicators that I sort of need to get in touch with someone?
So having negative cash flow for a short term is not insolvent. You may not be able to pay your debts as and when they fall due, but that short-term situation doesn't necessarily mean you're insolvent. There are numerous factors that are looked at, cash flow being one of them, but it's also asset to liability ratio, whether that's fallen below 1, whether or not you're paying your debts outside the standard terms, whether you're using round lump sum payments instead of paying specific invoices, whether you're bouncing checks, whether there are demands against you by creditors, proceedings are being issued. So there's lots of criteria. It'll also be a question of whether or not there is an ability to get further funds into the business in the future, whether from borrowings or sale of assets. And that's part of what using, for example, the safe harbour provisions are for. If you do think you're potentially trading insolvent, but you think it's not going to happen or there is some risk, using those provisions give you the protection for being personally liable for debts incurred while that's happening, while you figure that out and you put in place the restructure that's needed, the refinancing that's needed, the proper business plans that perhaps aren't in place. So the mere fact that you're in trouble for a short term doesn't mean you're insolvent, but it absolutely means you should be looking at what steps, if any, do I need to take to protect myself and to ensure that my business continues to trade in the future.
Awesome, thank you. So there's a couple of last ones that have come through that I'll just cover off on. And one is, how do you attract staff that will most appropriately fit with your business? So being really transparent and clear with your own values, and then working through your employee value proposition. So this is something we've done a lot of work on lately. It's one of the reasons we've launched the BlueRock Foundation, that we're having open and honest conversations with our people, but really starting with, well, what are your values and your values of the business? And then being transparent and opening that up as part of whether it's the job ads or the job description, so that the people applying should be more closely attached to that. And another one was, how can I get involved in the BlueRock Foundation? So we are running some small events. If you wanted to perhaps donate to it or set up a sub fund which can sit under it, like anything with this, if you've got any questions, please do feel free to reach out to us. I think that's pretty much all we've got time for today. And thank you so much for everyone for jumping on. And thank you to Claudia and Jared for your time. If you have any questions, please do feel free to shoot those through. As Claudia and Jared said, there's no cost to have an initial chat with any of us. We're more than happy to help. And if we're not the right people, then we can obviously put you in touch with someone else within the business that is. So appreciate you all jumping on, and thanks very much for your time.
Thanks, Joe. Thanks, everyone.